going to move on to a topic that's a little bit more broad. And this is a commentary in Bloomberg. It says, Wall Street trades at speed of light need traffic cops. Okay, what this touches on is high-frequency trading. Now, people think of high-frequency trading, they think, well, maybe a few trades an hour, a few trades a minute. But it's gotten to the point where a stock may be bought and sold within just a few milliseconds. And it's turned the market into a whole different beast than it was even 10 years ago, because the frequency of the trades and the kind of market that we're in is just so much different. Because I usually compare it to a game of billiards. You know, if you're out with some friends, everybody takes a turn, you hit the ball, and it's quite orderly. It takes a good amount of time. So let's say you had an hour game, everybody had their turn, everything was great. So at the end, you know what the result is, you know what the process was, and that, of course, leads you to a certain outcome. Now, imagine that whole billiard game was played in a second. Okay, everybody tried taking their turn, everybody tried to get their shot in, all in 1 second. You imagine the chaos that would cause. Nobody know whose turn it was. If someone's getting a pool cue in the eye, you know, it would be a complete mess. So that's one way to visualize, I guess, if I were to describe some way to visualize this high-speed trading situation. So what you have now is computers that are extremely fast. These companies get the most robust servers they could possibly find to make these calculations and get orders out into the market as fast as possible. The name of the game here is speed. It's not investing, it's not fundamentals, it's not value, anything like that. It's just price, and it's just the price now. So in this game, if you're a few milliseconds behind, you lost. It doesn't matter how much money you have, doesn't matter how great of an investor you think you are. If you come in just a few ticks late, you're out. That's why these companies have gone on to empty out entire office buildings and fill them with computers, specifically for the purpose of being closer physically to a stock exchange. So they're going to try to move it into the same building as the exchange, or in a building that's extremely close to get into the market that much quicker. And they don't only place buy and sell trades, they also cancel plenty of trades, these high-frequency traders. And the reason for this is to cloud the market with misinformation, to distort the analysis of the other guy. So if you have two high-frequency traders, in one respect, their goal is to make money on their own. But on the other hand, they also try to put misinformation into the market, so all the other players have to take that much longer to ascertain what the actual situation is as far as the other market participants are concerned. So that's a little bit of background on high-frequency trading. It's increased quite substantially, and now it actually amounts for most of the trading volume is high speed. So think about that. You have computers doing most of the trading, and they're doing it extremely quickly. Now, to say that this is short-term investing is an understatement, especially when there's hundreds of firms doing this, thousands of trades a second. You can only imagine what the market looks like. It's impossible to see left or right. So that's a little bit of background. This article says the past year in the U.S. stock markets earned a place in the Volatility Hall of Fame, coming in just behind the full-blown financial crisis years of 2008 and 2009. For this, credit or blame goes to Europe's debt mess, U.S. political paralysis, and upheaval in the Middle East. Okay, but something else was at play. The increasing dominance of so-called high-frequency trading driven by computers and programs that thrive on and exacerbate wild market swings. Now, it's important to differentiate also algorithmic trading and high-frequency trading. While it's true that most high-frequency traders use algorithms, it's also the case that algorithms can be used for long-term trading just as easily. It doesn't need to be necessarily high speed, so it's important to make that distinction. It says the U.S. securities regulators have been examining the trading records and computer codes of brokers, hedge funds, and banks. This welcome inquiry delves into the world where buy and sell orders are executed at speeds normally associated with astrophysics, and traders profit from opportunities that may last a few millionths of a second. And one of the things that these traders can do is actually called front running, when, let's say, institutional bank A is far from the exchange and a high-speed trader is close to the exchange. So when that large institutional bank places an order, this high-frequency trader, being closer to the exchange, might be able to get in just a millisecond earlier and front run that transaction by the institutional investor. So what that would do is give you an advantage and put you in the position to profit off of that institutional bank's move. Now, what that would do is would put the bank in a less desirable position because the prices they're going to get are not going to be as good. Why? Because somebody else got in the action before them, and if they were looking to buy something, these high-frequency traders started buying before their trade even hit the tape. So essentially, the institution would say, well, why are we going to the exchange? Because we're being bombarded by these high-frequency traders. They're front-running. They're getting in ahead of us. They're quicker than we are. So what these institutional guys do to avoid high-frequency traders is they invest in what's called a dark pool, a dark liquidity pool. Now, this is a subject of a whole other session. I think I'm going to cover this in a future webcast. But essentially what a dark pool is an exchange away from the exchange. So it's a private exchange where the size of the orders, the identity of the participants, and even whether to buy or sell is concealed to keep that information hidden from the actual stock exchange. So a lot of these institutions are turning away from stock exchanges because they feel they're being shortchanged by the high-frequency traders. The point I'm trying to get across here is this high-frequency trading has very significant repercussions because not only is it increasing volatility in the publicly traded market, it's also driving participants to trade through dark pools, which really doesn't benefit anyone when you think about it, because the whole point of an exchange is for the exchange to happen there, not for the exchange to happen everywhere else. So this is quite significant. It says, at this point, it's beyond doubt that high-frequency trading contributes to volatility, fueling perceptions among retail investors that insiders have the game rigged. One need only look at the so-called flash crash of May 6, 2010, when the Dow Jones Industrial Average plunged almost 1,000 points in an hour and bounced back just as quickly. Now, people that were trading that day, I think maybe a good 10% of them must have had some kind of heart attack, because essentially you saw the market just drop precipitously for no apparent reason. And they try to trace this event and identify where it came from, and it looked like some guy at some fund wanted to put a sell order. Instead of putting 1 million shares, he put 1 billion by accident, and it caused the market to crash and lose almost 1,000 points in a few minutes. So that shows you the kind of environment that we're in. Obviously, computers saw that trade coming. They saw the pressure coming from the sell side, and immediately they started to unload whatever shares, predicting that the market would indeed drop. And of course, that would trigger stop losses. That triggers sell orders. So let's say if a stock drops below 100, and the stock is then sold at the market price. So as you can see, it's turning the investment world into more like a casino, because the fundamentals, the company itself, the innovations they provide, what services they give, really none of that matters. None of that matters. All that matters is you getting the trade ahead of the other guy. It doesn't matter what the security is or where you believe the treasuries are going, what the spreads are. It doesn't matter. So this is why I tell people the market is a whole different beast than it was, because we're basically having technological warfare here, and it looks much less like investing than it did. Now, as the article mentioned, this high-frequency trading does increase volatility. So if negative news comes out, instead of dropping, let's say, 5% as it ordinarily would, now it might drop 10 or 15 in the same amount of time. So, of course, investors would panic. They would start selling because they don't want to take that much of a loss, and then it becomes a snowball effect, whereas each event in the market is so much more radical in terms of movement. So this is basically making investors lose confidence in the market, because now, even if you're trying to invest, you're out of the high-speed game, it's affecting you, because if the traders get a hold of your security, or the one that is 5–10% of your portfolio, you might take a big hit. It says the loss of confidence on that scale might, over time, diminish liquidity, increase trading costs, and erode investor returns. It says ideally, the Securities and Exchange Commission will accelerate a full-scale monitoring program that gleans all trading transactions. Good luck with that. Such audit trails might help the agency spot wrongdoing. But the securities industry, which will bear much of the potential $4 billion cost to hire analysts and buy computers that can keep up with the traders, has balked at having such information provided on a real-time basis. Well, there's a few things going on here. First of all, audit trails are not going to prevent anything from happening. They're just going to tell you where a certain trade came from or what might have triggered a certain market event. So audit trails are not proactive, they're reactive. So that's the first problem there. And of course, it's not going to stop another flash crash from happening necessarily, because many times it's also difficult to determine even what caused such a crash. So it goes on to say, one suggestion is that they can tax high-frequency trades. So if you make a trade, we're going to hit you with a tax, and one idea is that's going to slow down the high-frequency trading because it will raise the cost so much that it would not be as profitable. So that's one idea. Although it may play out well, what it may do is just move high-speed traders to other markets where they don't have a tax, and they will just hit those exchanges just as easily as they do it here.